All right, futures selling off a bit. 30 minutes till the start of the cash trade. I'm Matt Miller.
I'm Dani Berger. Bloomberg Open Interest starts right now.
Crude continues to climb as the U.S. and Iran battle for control of the Strait of Hormuz.
John Gray remains bullish, predicting Blackstone's best year ever for IPOs as deal-making picks back up.
And beyond Blackstone, we're digging through a wave of earnings today, from Tesla's AI push to Americans' rising fuel costs.
And that's all that matters today, not the fact that oil is yet again above $100 a barrel.
Yes, earnings. And that's what's driven this market to new highs. I mean, we want to continue to see that happening, and it doesn't look like Tesla.
I was going to say, not all earnings are coming in great, even though a lot of them are. Let me show you what Tesla is doing pre-market. It's down 3%. So profits blew past estimates, margins jumped. So initially you got a rally in share prices post-market, but then it raised AI and robotics CapEx spending to $25 billion. That's triple last year's CapEx. And there you get the shares fall.
Yeah, you got to pay to play, though. American Airlines says full-year earnings will be at the midpoint of its previous guidance as the war creates an additional $4 billion in expenses due to higher jet fuel prices. But they're going to be able to raise prices on consumers and keep a lot of that price increase, even if fuel reverts back to its pre-war costs.
I guess buy your tickets now. It's already too late. I'm not quite sure on that. Let's get back to Tesla, though. Joining us is Bloomberg Tech co-host Ed Ludlow. Ed, is this just about CapEx? Is that what the investor nerves are around?
Yeah, I mean, this is a monster number by Tesla's historical standards. And it was so interesting because Elon Musk opened the call by framing it in kind of like, well, you're familiar with CapEx. Everyone's doing it, so we'll do it too. But I guess that the nervousness is that it's not just a commitment to $25 billion of CapEx, it's the admission that it will immediately put them into negative free cash flow for the rest of this year. That kind of worries the market, even though their kind of cash pile is pretty good. And, you know, the market can be a fickle thing, but it was evidence that they're going to get going and spending on the future business lines, which is humanoid robotics. They explained how that will manifest, robo-taxi, and the other AI infrastructure costs that they'll have.
Well, and as we know, that's Tesla's main valuation driver, right? It's not the car business. However, I do want to ask you about the car business, Ed, because we've all had, friends that drive EVs who've been bragging over the last 6 weeks about how much money they're saving on fuel costs. You're one of those people. And so I would have expected a massive jump in EV sales. Yesterday, as you know, I was down with Sebastian Mackinson at BMW looking at their new 7 Series. He showed me a cross-industry snapshot of Q1 EV sales, and none of these car makers are doing as well as they did in the first quarter of last year. I mean, they're all facing massive drops for the most part. How is Tesla doing?
That would be logical with Tesla, and that's what happened. They were very explicit. High gas prices drove demand in the quarter. They're seeing a rebound of demand, not just in Asia Pacific and South America, where they're still kind of growing, but even in North America, they saw a rebound in demand. So that was like when the
But is it to the same level that they had in sales at Q1 last year when they had the tax credit, the $7,500 tax credit?
It can't be, because remember that the sales data that comes before earnings tells us no. They still are seeing overall weaker sales data than historically. It's a double-edged sword for them, because also right now they are facing the lasting and longer-term impacts of tariffs. That raises their costs. They also talked about higher interest rates raising their costs. But it was a kind of, I think 24 hours ago, we said we're just going to ignore the car numbers, right? And everyone that said that will now eat their hat, because actually, in the quarter gone, Dani noted on the top and bottom line, they outperformed because they had some short-term positive impact from the war in Iran and energy prices, but also something that we're not quite understanding yet. They got a one-time short-term relief from tariffs and positive FX impact as well. So that's just old school earnings stuff, right?
Ed Ludlow, co-hosting the close. Bloomberg Tech as usual. You'll probably be on the close.
I mean, you basically co-hosted.
Will you be on the close today?
If I'm invited, I'd be honored to be on the close.
Today's your last day in New York, am I right?
It's my last day in New York, and we have Intel after the bell, so that's another big one. By the way, Elon said that he would use Intel's 14A process, and the stock went bananas, and after hours, that's all you need to know.
Is he going to buy Intel eventually? Is Elon Musk going to buy it eventually?
The thesis of the street this morning is that we're actually moving now even closer to a world where SpaceX combines with Tesla in the future. Doesn't answer your question, but there you go.
He gets his nice pay package, right?
Yeah.
He reaches the capex he wants, or the market value he wants.
Yeah, I mean, a lot of the hedgies I talk to think Elon eventually is going to buy Intel, or at least that's part of the speculation.
Well, okay, what he did not say is whether they would license the tech or use Intel's foundry as a customer of Intel. They did not say either, so there you go.
All right, you get more of Ed Ludlow. We want to keep him, but he has to go prepare for his show. It starts at 11 a.m. You get more of Ed Ludlow then. Speaking of the war driving earnings, American Airlines says it's going to create $4 billion in extra expenses related to higher jet fuel prices, but they're going to be able to raise prices for consumers and keep at least some of those price increases, even if fuel reverts back to its pre-war level. And I think that's a key observation. Bloomberg Chief Global Aviation Correspondent Sid Phillip joins us now. And Sid, we heard this from the CEO. Clearly, shareholders are happy about that as the shares are up 2% in the pre-market.
So every airline has telegraphed that fuel costs are going to feature into their full-year earnings expectations. American Airlines, the fact that they've reduced their debt below $35 billion, which is obviously a big overhang for the stock. That's been something that's positive. And the second is the fact that demand continues to be, the airlines are talking about demand continuing to be robust even as they increase fares. And they're also talking about how they're going to cut capacity where it isn't profitable. So there is some element of the fuel prices reflecting in the earnings, but at the same time, there is sort of measures that the airlines are taking in order to try and sort of deflect from that. I mean, United Airlines yesterday talked about how they will be able to pass on 100% of the fuel costs by the end of the year. So airlines are looking to sort of take those measures to actually recover those costs.
Right. And I believe it was United Airlines CEO that said the thing about higher prices that stick around.
Oh, that was Scott Kirby?
Yeah, Scott Kirby said that. I do wonder, I mean, we're looking at American Air talking right now, I believe it's on their earnings call, saying that they will be on the forefront of M&A if opportunities arise, something you and I had talked about yesterday on the Deal Show every Wednesday at noon. Is the stress enough that this is what causes more M&A? Or was this inevitable at this point, Sid, that we would see more consolidation?
So it's a sort of question of what would have come first. And I mean, this is something that is a sort of immediate pressing event for some of the weaker carriers, that they need to look at M&A because that's the only way to survive, especially as costs start skyrocketing. I mean, fuel is the most expensive, biggest chunk of expense for an airline. And so when they start sort of fueled by the bills keep rising, I mean, airlines have to be able to sort of fend off that. And a lot of airlines that have weaker balance sheets will not be able to sort of get through that. And we're seeing some signs of that. I mean, yesterday we've been reporting on Spirit Airlines, and Spirit Airlines looking at a government bailout. It looks like the government is going to give them a bailout, and the government may take as much as 90% of Spirit Airlines. And so Spirit was one of the airlines that's in its second bankruptcy at the moment. They were looking to get out of second bankruptcy, but given the higher fuel prices, the math doesn't matter anymore, and so they had to get a bailout.
By the way, why do you think the government, given what we saw happen during the Obama administration with General Motors and the bailouts of Detroit, why would the Trump administration want to do that again?
So Spirit Airlines is a large employer in Florida, and they sort of are a massive sort of influence on the East Coast of America, and so for Trump, the optics of losing 14,000 jobs was something that they said was not worth paying for. And so Spirit Airlines is, a low-cost carrier that sort of gets a lot of people across the country. And like a low-cost carrier failing would somehow, maybe it works for their image to sort of support them.
Yeah, we talked about more stimulus heading into the midterms. Maybe this is part of the form it takes. Sid, thank you so much for joining us. Bloomberg's Sid Phillip. Now, back to the war in the Middle East. President Trump saying on Truth Social moments ago that he's ordering the U.S. Navy to shoot and kill any vessels laying mines in the Strait of Hormuz. The U.S. also intercepting Iranian oil tankers as it awaits Tehran's response on restarting talks. Joining us now is Bloomberg Washington correspondent Tyler Kendall. Tyler, I gotta say, it kind of has a feeling of escalation. It's something the markets were worried about, clearly not this morning, but it doesn't seem like the rhetoric is cooling down at all.
Right, Dani. I mean, at this point, it appears that the standoff over the Strait of Hormuz is definitely worsening, threatening the potential prospects for a deal. We got this post moments ago from President Trump when it comes to mines in the Strait of Hormuz. He went on to add that the U.S. is going to double its efforts in trying to clear the strait, which comes on the heels of the Washington Post reporting yesterday that a military assessment shared with Congress is estimating that any such efforts could take nearly 6 months to complete, just underscoring really how dangerous conditions remain. Now, we should say that a Pentagon spokesperson did tell the Post that that information was inaccurate, but it's definitely raising the stakes and the potential timeline here for when we could see a safe strait, because Iran has repeatedly said that they do not want to resume negotiations until the U.S. lifts its naval blockade. But the thing is, President Trump has maintained that it's not going anywhere. And as you just mentioned, new this morning, the U.S. military confirming that it intercepted 2 Iranian oil supertankers. It says they were trying to evade the blockade. It really just marks the latest in this week's efforts by Iran to appear to test the U.S.'s limits when it comes to the waterway. Of course, we heard the IRGC say yesterday that it had seized 2 vessels that it says were trying to make its way through. But Matt and Dani, when asked about this, the White House maintains that none of this is a violation of the ceasefire, particularly in the case of those 2 seized vessels, they say, because neither were American or Israeli flagged.
All right, Tyler, thanks very much for joining us. Tyler Kendall in Washington. We'll come back to her in the next hour. Check right now on what's going on with markets. S&P futures down about 0.25%. NASDAQ futures off as well, although only 0.2%. And of course, we were up yesterday 1 full percentage point on the major benchmark yesterday. In terms of Brent crude, we see it continue to climb a bit right now, 102.49, and that $100 level has been one that seems to make the administration uncomfortable. So we'll see what we get as a reaction, if anything, to the repricing of oil.
But at the same time, the White House putting out on Truth Social, thank you, Mr. President, stocks, NASDAQ, S&P are at all-time highs. So
yeah, and that's not wrong. I mean, this market is absolutely on fire. And although oil has repriced, we haven't seen too much of that in stocks. We saw, the valuations come down to like 20 times forward earnings, but now we're back to 21, now we're back to 22, and we continue to climb again.
By the way, I spoke with John Gray this morning. We're going to play out more of that earnings conversation, but he talked about this. Let's actually look at what Blackstone is doing this morning, because they did report earnings. The earnings topped estimates as the company expects 2026 to be the best year for IPOs ever. Originally, shares were higher, but then they announced a dividend cut, so perhaps that's why shares are off this morning. As I said, I spoke with the company's president, John Gray, about his outlook for the economy and his portfolio companies following the results.
In aggregate, the picture is pretty good. And the big driver goes back to what we talked about at the beginning, this huge AI infrastructure boom. 5 companies spending $700 billion in capital. Even as we have a shock like we're seeing with the war, we can continue to power through. Our expectation is we'll see a pretty healthy economy despite these headwinds.
And you're going to hear more from our interview with John Gray throughout the show. Elsewhere, IBM software sales, they were in line with estimates, failing to shake investor concerns about AI disruption to its business. Matt, those shares down nearly 7.5%.
ServiceNow reported results that disappointed investors and said some sales deals have been delayed by the war in the Middle East. The CEO of ServiceNow, Bill McDermott, joins us at 10:45 a.m. with Caroline Hyde.
Coming up, we're going to talk more about Tesla's robotics progress and how the Iran war is impacting the auto industry. We're going to speak with TD Cowen's Itay McKelly. This is Bloomberg Open Interest.
Let's get now to high interest. Look what's making headlines around the world. Navy Secretary John Phelan has been fired after clashes with Pentagon leaders over President Trump's push to revive U.S. shipbuilding. The move comes as military tensions tied to the Iran war are rising. The Navy's undersecretary will step in as operations continue in the Strait of Hormuz. Cannabis stocks are higher after the DOJ moved medical marijuana to Schedule 3, signaling looser federal controls. Major names like Tilray, Aurora, and Canopy Growth are all surging in the pre-market. A broader federal review of the rescheduling is set to begin in June. And Netflix is betting on itself, launching a $25 billion stock buyback program after shares slid more than 13% in weak forecasts and leadership turmoil. The company is also stepping back from a major media deal fight, collecting a $2.8 billion breakup fee while signaling long-term confidence. Dani?
Elsewhere in earnings, Tesla is tripling its spending plans for AI this year to $25 billion as investors look for signs of progress in its robotics push. TD Cowen senior analyst Itay Michaeli has a buy rating on Tesla and joins us now. I know in your take of their earnings, you said more positives than negatives, but Itay, I got to say, at the moment, it feels like this is a market concentrated on those CapEx numbers. Shares are down 3.5%. What did you make of it?
Yeah, thank you for having me. So you're right. I mean, the CapEx number has been in focus. The stock has been kind of recovering ground, so a little bit of a pullback on the CapEx numbers, I suppose, makes a little bit of sense here. But the CapEx really isn't new information. They did already guide to a significant amount last quarter. Yes, it did go up again this quarter, but we don't think that the CapEx is likely to linger here for too long, just given some of the momentum we're seeing not only on the AI side, the FSD side, of course, robo-taxi, but also on the EV side as well, where the company we thought made some pretty positive comments around recent demand trends.
I mean, isn't it good that they're going to spend $25 billion? They're a $1.4 trillion company. And I mean, that's a bigger market cap than every single automaker on this planet combined.
Yeah, it's a great point. They are at the center of several global megatrends in AI, electronics, manufacturing, of course, EVs, and they're rolling out significant products and services, and those do require investments. And look, we will get proof points later in the year from the Cybercab ramp, for the robo-taxi expansions, the potential for FSD on consumer vehicles to go eyes off at the end of the year or early next year. Of course, the launch of AI5 next year. So yes, you have a big CapEx number to your point, but you also have a number of fundamental catalysts that can serve as proof points that this company is heading in the right direction and unlocking these very significant opportunities. And that's why we don't think the CapEx number is likely to linger as an overhang going forward. And underneath it all, the EV business we think is starting to come back. We actually published a very large report about a month and a half ago calling for the bottoming of U.S. EV sentiment. We were pleased to hear last night the company talk about recent order uptick, including a record Q1 backlog.
When it comes to the timelines for things like, robo-taxis, Optimus, the Cybercab, the Semi, they always tend to be a little bit squishy. When do you have these included in your earnings models?
Sure. A lot of it's still upside to our model. I think the one area that we think could be maybe the biggest catalyst could be eyes off on consumer vehicles, because that doesn't just accrue to more FSD subs and more revenue on the existing install base. That actually could be a significant driver in our view of vehicle demand going forward, given the significant amount of new services that you can launch, even in easier markets, easier conditions. You don't need to deploy in major urban areas to unlock significant new services and revenue streams and ultimately vehicle demand. So we think FSD eyes off could be a significant catalyst into next year, both for revenue as well as vehicle demand to kind of get that virtuous cycle going.
Itay, I think it's fair to say you're one of the most respected autos analysts on the street. You have spent at least 2 decades, right, covering car makers around the world. I was pretty stunned yesterday when I got a look at EV sales in Q1 compared to EV sales in Q1 last year across automakers. Almost all of them have declined really significantly. And I would have thought that in March, we would have a huge rebound in EV sales. But I guess higher fuel prices, at least $4 a gallon on average, is not enough to make up for the $7,500 tax credit that we lost last September.
Sure. So I'll throw out 2 data points on that may paint a bit of a different picture as what we saw in March. So if you look at the reporting EVs, the actual vehicles and companies who actually report monthly sales, the mix of those relative to overall vehicle sales was the highest in March since IRA credits expired. So we have seen sort of an improvement sequentially. The year-over-year comparison, of course, is still difficult, as you point out. But even on a year-over-year basis, when you look at it on a sales relative to inventory basis, because, of course, EV inventories also come down a lot year over year, sales relative to inventory in March of this year was flat year over year, meaning consumers pulled down roughly the same percentage of inventory as it did last year in terms of demand. So those are two encouraging signs. Of course, it does take some time for the impact of higher gas prices to flow through. Our core thesis on EV2 argues that significant new product is actually coming in the next 12 to 18 months that could catalyze significant demand in the U.S., just given the certain structural advantages we have in the U.S. to drive EV adoption.
All right, Itay, great to get some time with you. Really appreciate it. Hope we get you back soon. TD Cowen senior analyst Itay Michaeli. Tomorrow, we're going to talk more about the auto industry with the ChargePoint CEO, Rick Wilmer. And you should always, if you care about cars, check out my podcast. It's called Hot Pursuit with Hannah Elliott. I'm currently driving the i7, the BMW, the new BMW electric vehicle. Last week, I drove the Lucid. A few weeks before that, I drove another Kia EV9. So I'm immersing myself in these EVs.
I know you liked the Lucid a lot.
I did, but you know what? The i7, it's so comfortable.
Really?
It's so big. It's so fast. Obviously, it's also very expensive. But they did a fantastic job. And I'll give you more on Hot Pursuit. This is Open Interest.
Five minutes ago into the start of trading, some of the movers we're watching. American Express, those shares falling 1 1/3%. They said that spending on its premium credit cards climbed in the first quarter as it prepares to revamp its business credit lineup. But clearly something went wrong.
I mean, the price went way up.
True.
So
it's
of
like
course.
nearly $1,000. It's crazy.
Yeah. Well, you can reap a lot of benefits if you're studious.
Yes, that's true.
And rigorous about it. Keurig Dr. Pepper beat earnings estimates after completing its takeover of JDE Peet's, and international sales steadily increased. I will say Hasbro also out with earnings. Preliminary results showed revenue growth in double digits as its Magic the Gathering sales continue to climb.
Cool.
So many nerds out there. Less than 4 minutes until the opening bell. We begin the trading day with Blackrock's Gargi, Chaudhuri. Stay with us. Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on with stocks. Futures are lower. This is after a 1% gain yesterday. So I don't know why I should have said we hit an all-time high at yesterday's close. And
NASDAQ too.
We continue to make new highs on the S&P and the NASDAQ. Dow 50,000 is not. Hey, we still show the small caps here. I thought since Katie and Shanali left, we would show the Dow over here.
It's not at 50K, I can tell you that. I know it's not. It's like still at.
There you go.
You know, just below.
So Pam Bondi can't come back yet. In terms of the bell, L3 Harris here ringing the bell. They're very happy people. Their stock is up. Like if you reinvested dividends, about 75% over the last 5 years. They make defense tech, so obviously they're doing well. If we're in a war, radio comms, their strong point there. Roku ringing the bell at the NASDAQ, and they're in a good mood because they just passed 100 million subscribers, and because maybe they haven't been looking at the stock chart. I always look at a 5-year, I default to 5 years because the Bloomberg terminal does, and that's a horrible default for Roku because it goes back to like the heart of the pandemic when everybody had nothing else to do but watch Roku. So the stock is down 66% in 5 years.
Got it. That's pretty tough for them.
Yeah.
I have a Roku. I don't watch anything on it though. I have the physical thing, but it's not plugged into my TV.
Yeah, I have a couple of them that I mean, Apple TV is.
Sure, I got an Amazon
really
Fire.
good.
You know, there's a lot of choice out there. I'm looking at Tesla here at the open. Shares are down about 3.5%. So just on the top and bottom line, things did look good. The estimates, the earnings blew past estimates, margins jumped. The issue for them, though, is that they raised their AI and robotics capex. It's going to be $25 billion for the year, and that is triple last year's capital expenditures, Matt.
Yes, but still only $25 billion. And those numbers seem small since I've heard all of the hyperscalers' capex numbers. We're not talking about $100 billion, and they're a $1.4 trillion company, so it's a tiny percentage of their market cap. American Airlines says full-year earnings will be at the midpoint of its previous guidance as the Iran war creates an additional $4 billion in expenses due to higher jet fuel prices. But as we've been talking about, airlines are able to raise prices. You know, consumers will pay it, and it's a great excuse. Plus, as you corrected me earlier, is Scott Kirby, right, from United, who said, like, look, even if we go back to the pre-war price of jet fuel, we're still going to keep a sizable chunk of these price increases. And they have to, like, claw money away from consumers because over the long term, airline ticket prices have actually gone down, inflation adjusted. So
it still has that, like, post-COVID feel to it, where companies who rose prices basically said, oh, people will keep paying it, and we're going to keep prices there. So doesn't that kind of pretend that any inflation hit we might get from this war maybe sticks around for longer than we thought?
Yeah. It tends to be fairly sticky. Joining us now is Blackrock Chief Investment and Portfolio Strategist for the Americas, Gargi Chaudhuri. And Gargi, we get stuck on inflation and the war because these are, I guess, interesting or important issues. But if you take those things away and just look at the market, it's doing incredibly well. Corporate earnings are really strong. I guess like $100 Brent is something that we can easily deal with.
Good morning, guys. It's great to
morning.
be here. Thank you for having me. We were in the process of writing our spring investment directions, which we just released yesterday, through this headline-driven volatility. And one of the questions that the team and I asked ourselves was, what are we still going to be talking about? Not in March and April, but perhaps June, in May. And to you guys' point from before, I think slightly higher inflation, the impact of this $100 or over $100 oil prices, and what that means for your portfolio is going to stay with us. So does that mean a little bit more inflation protection in the form of tips or commodities? Does that mean some allocation to durable growers like energy security, and then keeping the core of your portfolio in diversified assets we think makes sense?
But still like $300 plus earnings on the S&P for 2026, right?
Absolutely. So in the middle of earnings season right now, and I think one of the things that we've seen in the few that have reported so far is not yet a tremendous amount of concern around much higher oil prices. That hasn't come through yet, and strong beats. So coming into this earnings season, one of the things that was different from others was we didn't revise lower, we revised higher, especially across tech and a little bit across energy. And focusing on AI as a result of that, another one of our durable grower themes is what I think investors have been doing, especially over the time that we saw that volatility. We definitely saw investors pouring back into names like Semiconductors, into tickers like our Blackrock AI fund.
By the way, in terms of earnings revisions going higher, the MLive team did this really good study basically saying it was basically due, to your point, to one sector, tech, but one company also within that, the Micron, that basically it had a 5 times bigger uptick in earnings contribution than it did NVIDIA, which is about 10 times Micron's size. And then you get into later in the year, we're also expecting more big tech AI-related companies to come into the market between OpenAI, Anthropic, SpaceX, if you can kind of lump it in there. Is this a market that's due to just get that old concentration problem again, that the tech leadership weighs and acts as like the pillar for a bull market?
It almost does feel like this is a market where investors want to go towards where there is earnings growth. And as we see now, that 35.7% earnings growth is in tech and friends, tech plus sectors. And yes, perhaps that means that we have a little bit more concentration at the top. But what I would also point out, especially in this earnings season, as opposed to 12 months ago, you are seeing more sectors in the S&P with positive earnings growth than we saw this time 12 months ago. So there is that broadening out theme that is also happening. But while that's happening, you're certainly seeing tech and AI specifically retain its top power.
Does it surprise you that we continue to see the rates holding in this range? I mean, I know a lot of people at the beginning of the war were worried and watching closely the 10-year and thinking, like, if that gets to 450 or above, it's a problem. If we stay below that, we can look through this war and we're cool.
You know, no, it doesn't surprise me because I think the theme over the last sort of 12 to 24 months has not at all been about interest rate sensitivity or duration. It has been about income. So if you think about the 55% or so higher in oil prices that we got, 10-year treasuries have been remarkably resilient. It's basically moved between 10 and 15 basis points up or down through this inflationary backdrop. So what I think that means for investors is earn some income in your portfolio with allocations to asset classes like securitized, emerging market. You know, we do that via a ticker called a Blackrock income, bank, and then add some inflation protection in your portfolio with TIPS, with STIP, which is an area of the market we think will continue to gather inflows.
Why outside the U.S. is your call emerging market over developed market?
Yeah, so the reason there is more and more emerging markets are becoming also another way to diversify outside of the U.S., but stay in that AI theme. So if you look at IEMG and how it's composed, about 45% of that is today comprised of AI-related themes, as opposed to a decade ago, tech was only about 20% of IEMG. So more and more clients are telling us, we love this AI theme, we like the earnings growth. EM has earnings growth revised up to about 36%, as opposed to many parts of the developed markets outside of the US.
Gargi, thank you so much for joining this morning. Great to have you. That's Blackrock Chief Investment and Portfolio Strategist for Americas, Gargi Chaudhuri. Let's get a check on your equity market right now, about minutes into your trading day. And we are falling, but we hit a record high yesterday for both the NASDAQ and for the S&P 500. I just want to point out, as to what's leading us, it's semis. Semis have been on this insane run. They've been higher, the Philadelphia Semiconductor Index, for 17 consecutive days. That's the longest winning streak in history since that index was created in 1994. We're also trading at a record high price. Texas Instruments is the best performer, also a semi, had really strong earnings. Intel, they're going to report after the bell, but we learned of a Tesla investment into Intel, or at least a cooperation between some of their production. Analog devices doing really well. Again, it's semis are ruling all. Apple up about 0.5%. On the downside, IBM, some earnings that failed to capture the imagination of the investors. Microsoft, that's down 2.6%. Meta, Nvidia, those not having a great day. ServiceNow also reporting earnings down a whopping 14%. In about an hour's time, a little bit over that, we're going to hear from Bill McDermott. But because of those big cap tech names that are down, information technology as a sector is down this morning, despite the fact that semis are on this huge monster run. At the top of the pile, you have utilities, industrials, and real estate. Matt.
All right, so semis are crushing it over the longer term. IT, though, down today. Coming up, Intel gets a boost from Tesla ahead of the earnings that are coming after the bell. So Intel earnings are coming after the bell. We'll talk to Mandeep Singh because he runs Bloomberg Intelligence's tech coverage globally. This is Bloomberg Open Interest.
About 15 minutes into your trading day, let's get you the top calls, what the sell side is saying. First up, JP Morgan. They've cut Avis budget to a sell, saying the stock's recent surge is driven by a short squeeze, no duh, and it's pushed valuations way past what the business actually supports, also no duh. The stock has increased nearly 200% since the beginning of this year. JP Morgan expects that the rally will soon fade. We did see at the open, Avis was halted. I mean, look at this, hockey stick all the way down, and now it's trading again. I believe it's declining. You just were looking at that declining precipitously.
Oh, yeah.
So those shorts are probably sighing a breath of relief.
Duh.
Next up, Rothschild and Redburn. They're upgrading McDonald's, saying that the chain is pulling off its biggest value reset since the dollar menu days. They also note that weight loss drugs are still a risk, but remain too expensive to impact McDonald's core low-income consumers. Those shares up 1%. Finally, Tesla earnings highlight a spending surge in its AI and autonomy push. Morgan Stanley says that the long-term vision is aggressive, but near-term upside looks limited. Barclays also says that Tesla is entering a key investment phase, but notes that the update offered little new information. Matt.
I love, the Avis story.
Oh, it's so
yesterday, the stock traded at $847.70 a share. Today, it's trading at $343.88.
It's amazing.
What an incredible story. All right, let's talk tech, though. We are joined now by Bloomberg Intelligence Global Head of Tech Coverage, Mandeep Singh. And Mandeep, there's so many places we could go today. I think just to get it out of the way quickly, because we've been talking about Intel's increased CapEx, and $25 billion for a $1.5 trillion company doesn't sound like a ton to me, especially since all of their valuation, or a huge part of their valuation, is based on them doing well in AI, in robotics, in autonomy. So they have to be investing in this stuff.
Yeah, and you're right. I think Tesla's $25 billion contrasts with Google spending probably $180 billion in CapEx this year. all of the other Mag 7 players who are building these AI data centers have north of $100 billion in CapEx. So from that standpoint, Tesla is incorporating LLM in their FSD software. In fact, the latest version that they have released uses LLM. So I'm not surprised that they are raising their CapEx. And look, when it comes to physical AI, the opportunity is huge. Probably it's not a 1 or 2 year thing in terms of mass adoption, but everyone is investing in physical AI, and I think Tesla is definitely ahead in that race, and it's the right time to keep investing.
By the way, Intel, I just want to quickly bring up, because Intel this year is up 83%. It still has a relatively small market cap, right? 337 billion. Compared to other chip makers like NVIDIA is teensy-weensy. Does Elon Musk eventually somehow buy Intel? Because he's so into putting up this, what does he call it, a mega fab or a
terafab.
Gigafab? Terafab.
Yes.
There you go.
Well, look, I mean, Elon Musk is the first one to call out that we have a real problem in terms of dependency on TSMC for everything. If you're making GPU, NVIDIA has got all of their allocation with TSMC. Same thing with Apple to make their chips. So companies like AMD and even Google TPU cannot ramp up faster because there's no capacity. So what Musk is saying is, we'll set up a terafab here, wherein I'll work with Intel and make sure that we have enough leading edge capacity here. And so conceptually, it sounds like a good idea. Whether he's going to put a lot of money and a possible acquisition, I don't know. But I think, to my mind, he's highlighting that real constraint, given the geopolitical situation we have, in terms of TSMC dependency. It makes a ton of sense that, you want Intel to succeed, especially on the fab side.
It's something people talk about on the street, right? Which is why I'm bringing it up, because I keep hearing it lately. Do you hear that?
I don't, to be honest, but it wouldn't surprise me.
Please tell Dani, guys.
Yeah, send me messages too. Hey, Mandeep, thank you so much for joining us. That's Mandeep Singh of the Bloomberg Intelligence team. Let's get a look at some of the other movers on our radars. As I mentioned, semis on a tear, and Texas Instruments adds to that. They give a strong forecast. Companies spending big on data centers and industrial equipment. Semis now up for 17 consecutive days, the most ever.
Honeywell said war in the Middle East is hurting revenue in the process automation unit that serves customers in the energy industry, and as a result, those shares are down 2%.
Lululemon has typed Nike veteran Heidi O'Neill as its next CEO as Lulu struggles to dominate the athleisure category that itself created.
I mean, still, 20 years later, I can't get over the athleisure, the term athleisure.
It's staying. I think you gotta get used to it.
I'm not going to embrace it, but I'll accept it.
Sure.
Coming up, Blackstone's president says this is still the year of the IPO. More from our conversation with Dani's conversation with John Gray. Next, this is Bloomberg Open Interest.
Blackstone reporting a larger than expected jump in distributable earnings boosted by a robust start to the year for deal making. I spoke with the firm's president and COO, John Gray, following those results.
When you look at the quarter, we're really proud of it because it showed we're an all-weather firm. We had this 25% increase in distributable earnings. We had nearly $70 billion of inflows. But the real key driver is what you're hitting on, which is the strength in performance, which was driven by the focus on AI infrastructure, this massive build-out that's underway. 8 of the top 10 investments for us in terms of performance in the quarter were around data centers, LNG, battery storage. And it's really rippling through our firm, to your point. So it impacts our real estate business, our infrastructure business, our private equity energy business, our asset-based finance area. There's just so much need for capital to deliver this compute. It is really essential now to our firm in driving returns. And we see this shortage of compute and need for capital is really something that's structural now. So it's a big opportunity, and it's clearly the biggest driver for us today.
And you clearly, with $69 billion, pulled in the capital to be able to achieve something like that. I wonder, though, on the more AI side of things, John, because we've heard a lot of different partnerships with private capital firms, inking with Google, with Anthropic. Just this morning, we learned about CVC and Google. Are you partnering with any LLMs?
Well, we're not in a position to announce anything, but obviously getting this diffusion to happen is very important, getting this into our portfolio companies. So we're working on one of these opportunities. We want our portfolio companies to move quickly because we think it's a key competitive advantage. And what's nice about private equity firms, particularly us with more than 270 companies, we can really move the needle. And I would say what's exciting is today we're seeing a 15-fold increase in large language model spending for our companies off of a small base. But I think it's still early days. There are so many opportunities to improve efficiencies, to make content creation better. So big opportunity. The challenge is to change workflows. It's not easy to do, but it can have a big impact on our companies.
Well, we will stay tuned for any announcements. I feel like that was a nice little teaser in there, John. On the other side of this, though, there's the fear of AI disruption in software. I know your exposure is something like 7%, but you have seen some write-downs. Do you think we've hit the peak of write-downs, or might there be more to come?
Well, I think there's a couple things to note. One of the things we've seen is these companies have continued to perform well. And rightfully, folks would say that's in the rearview mirror, but I think it's an interesting data point. I do think there's going to be some disruption here. It's not all going to be the same. I think the outcomes will be heterogeneous. If you compare it to maybe retail 25 years ago, there were plenty of Sears and Kmart's, Toys R Us, but also companies like Walmart and Costco who are really more infrastructure-like. And I think that analogy will hold in software. Many of these companies who are really systems of record, they're deeply embedded. I think they have a good position, but the management teams are going to have to adjust. So I do think we're going to see here this spreading out. I also think overall in the sector, we have seen a re-rating lower in multiples because there's more uncertainty. And it goes beyond software to information services, professional services, really the white-collar world. So I do think we've seen a reset. And of course, managers have to adjust valuations. We've done that in the software area. Multiples have come down quite a bit for these companies. So I think it's an evolving, sort of playing field. And companies cannot sit still. They're going to have to move into an agentic world.
And I know you were pretty early, Medallia, for example, in writing down the value of that loans. There have been reports that Thoma Bravo is handing back the keys to you and other lenders. Is that the case, John?
Well, I can't talk about the specifics of the situation. Medallia has been well reported to be having challenges well before AI. I mean, issues around this credit go back more than a year ago. I do think what's interesting there is it's a situation where we and the other lenders lent less than, I think, a third of the total cost. The equity sponsors had to lose more than $5 billion before you had a transfer here to the potential transfer to the lenders. But here again, the lenders also have taken write-downs. So the valuation multiples are down very dramatically. The overall value's down dramatically. I do think the business under a new management team can do much better here, but obviously they're going to have to pivot as well to this new world.
Blackstone's John Gray, and we're going to have more from my interview with John in the next hour. And it was that final question there. There's been this drama over Medallia. Does it become the poster child for software? But to be fair, as John mentioned, it was having issues even before all of the AI stuff.
Yeah, it has been well reported, but we're, I guess, waiting to see if Thoma Bravo indeed hands over the keys and if the creditors can make money on that business. Coming up in the next hour, Morgan Stanley's Andrew Slimmon joins us at the desk. We will also talk with Caroline Hyde and CEO Bill McDermott, CEO of ServiceNow, Bill McDermott, and I will focus in on what's going on in the Iran war. This is Bloomberg. We are 30 minutes into the trading day, looking at some slight losses. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. Again, slight losses. Even though oil is moving higher, it's still above $100 a barrel, but we are still just hovering around all-time highs.
Yeah, and we closed again at an all-time high on the S&P and on the NASDAQ yesterday. Despite the rise in oil, Brent crude continues to climb as the U.S. and Iran battle for control of the Strait of Hormuz.
John Gray remains bullish, predicting Blackstone's best year ever for IPOs as deal-making picks back up.
And beyond Blackstone, we are focused in on Earnings. Tesla, their AI push to Americans' rising fuel costs. We continue to see big numbers put up, and I was looking 12 months out, the average analyst estimate for S&P earnings is almost $350.
It's wild, but my favorite fact, I said this earlier, is that from MLive, basically Micron is the chunk of that. Like Micron is all of that. It's had so many earnings revisions, and it's 5 times the amount of earnings revisions contribution that NVIDIA has, despite the fact NVIDIA is 10 times bigger. So it's very, very concentrated, that
well, that's why the stocks,
earnings.
Isn't it?
Is 17 days running that it's been gaining, longest running streak ever. Back to one of our top stories, though, this morning. President Trump saying on Truth Social this morning that he's ordering the U.S. Navy to shoot and kill any vessels laying mines in the Strait of Hormuz. The U.S. also intercepting Iranian oil tankers as it awaits Tehran's response on restarting talks. Let's go to Washington, D.C., to our Bloomberg Washington correspondent, Tyler Kendall. Tyler, where do we stand in the potential for restarting talks? These words, these missives don't seem to be getting us anywhere.
Well, Dani, at this point, it appears that the standoff over the Strait of Hormuz is only escalating, and we know that that is tied very closely to whether or not we see another round of in-person talks, considering Iran's hard line has been that they will not resume for another round of negotiations until the U.S. lifts its naval blockade. The thing is, at this moment, President Trump has maintained that it's not going anywhere, and instead we're seeing this doubling down in these posts on Truth Social this morning, as you're discussing, saying that the U.S. is now taking additional efforts to try to clear the Strait of Hormuz from mines. And this comes on the heels of some reporting yesterday from the Washington Post that a military assessment shared with Congress estimates that it could take up to 6 months for that effort to be completed. And that's really just raising the stakes here and underscoring how dangerous those conditions remain, because this past week really marked moves by Iran to try to test the U.S.'s limits, if you will, including Iran seizing some vessels that appeared to be trying to exit through the Strait of Hormuz. Now, with all of this said, we can say that the White House maintains that this ceasefire is indefinite, amid some reports that it may have had a timeline. But yesterday, officials came out and said that they are giving Iranian leadership time to come back to the table with a new proposal for the U.S. to review. And Matt and Dani, we can also point out that Pakistan still says that they are highly engaged in trying to get these talks underway. The country's prime minister met yesterday with Iran's ambassador.
Tyler, from the beginning, I've been kind of stuck on the nuclear issue here. And again, Carolyn Levitt yesterday said that President Trump wants Iran to hand over its stock of highly enriched uranium. But just this past Monday, the president said on Truth Social that we completely and totally obliterated the nuclear dust sites in Iran with Operation Midnight Hammer last year, and that it would be a long and difficult process to get down to that uranium, even for the U.S. military. So, like, how do you square that circle?
Well, you're definitely right, Matt. There seems to be some contradiction here when it comes to the president's rhetoric, though we can, of course, say that intelligence assessments did say that after last June's operation, significant damage was done to Iran's nuclear program. But it is still clear, even according to the president, that the U.S. is very set on getting this stockpile of highly enriched uranium. He refers to it as the dust, but this is the material that we are talking about. And we know that it's critical to Iran, considering that they have repeatedly said that they have not made any of those concessions that President Trump has outlined. Now, experts will often point out that when you hear the president talk about Iran allegedly agreeing to not have a nuclear weapon, that's not necessarily news, right? Because Iran's public stance throughout these negotiations is that they don't want a nuclear weapon. But it is instead when we get any sort of movement when it comes to enrichment or what will happen to that already enriched material, that is where we are trying to glean any details on whether there or not we could see a potential solution. But Matt, as you know, earlier this week, there had been, or last week, rather, all the time is running together, there had been that reporting that maybe we could see a transfer from an unfreezing of Iranian funds in exchange for that stockpile, though President Trump came out and said no such deal was going to happen.
Tyler, thank you very much for your work this morning. That's Tyler Kendall in Washington. Blackstone President John Gray is optimistic on the economy despite some of the headwinds coming from the war in Iran. I spoke with him following his firm's earnings report.
In aggregate, the picture is pretty good. And the big driver goes back to what we talked about at the beginning, this huge AI infrastructure boom. 5 companies spending $700 billion in capital. Even as we have a shock like we're seeing with the war, we can continue to power through. Our expectation is we'll see a pretty healthy economy despite these headwinds.
Joining us now is Andrew Slimmon, Morgan Stanley Investment Management Senior Portfolio Manager. So whether it be the private market players, these public markets trading around all-time highs, we're pretty sanguine. Are you as sanguine about the moment we're in?
Well, it's crazy. You know, a month ago, if I had sat here, I'd say earnings are good. The narratives are missing out that earnings are going up. And not only are earnings going up, the revisions are going up. And that's really powerful. But now you've had a 10% rally in the market. Markets are fully pricing that in, and I'm worried because what we're seeing now in the market's trading into this very tight group of very speculative stocks and leaving the rest behind. And if you go back and look, really over the past year, whenever that's happened, usually there's something bad that's happened right around the corner.
I always pull up EEO, S&P index, and then EEO Go, and it shows you forward 12-month earnings expectation at like $325. Blended is $343 or so, like massive. And so the PE on that is still like slightly less than 21.
Well, I'll give you even better detail. If you think about where the market could end this year, right? It's going to be 2027 earnings. The consensus started this year that earnings for next year was going to be 357. It's now 375.
Massive.
We're 1 quarter in, and the estimate is up $18. This is big. What happened? So you fast forward, that justifies a high 7,000 S&P.
Yeah.
Unless the economy really collapses, which so far it really hasn't.
So this is my question. If we hold at $100, or let's say 90, right, for WTI, does that make a meaningful difference to those estimates or no?
I don't think so. I really don't think so. I'm more worried about the signals of the market. The breadth has gotten very narrow. It's gotten very speculative in the last week or so. To me, that's a more dangerous short-term sign. But ultimately, what drives stocks is earnings. Earnings are coming in strong overall.
Just to that point, and I know that this is an index that you monitor sometimes too, a rival firm, but still, it's the Goldman Sachs Unprofitable Tech Index. You pointed this out. This thing was just trading at all-time highs. I mean, look at this. It's pretty remarkable because this isn't necessarily, really robust earnings. Everything is sunny. Everything is great. So what does it tell you about the nature of this market that something like this, unprofitable tech, has been on such a tear over the past month?
That index off the COVID low to the peak in 2021 was up 450%. It's never gotten back to where it was, right? And so when people chase non-fundamentally driven stocks, it's a sign of late euphoric. Bull markets end in euphoria, so that scares me that people are chasing after stocks that are a theory, a hope down the road. It's generally a bad sign for stocks.
What do you think about, rates have held really steady, and I know a lot of people were worried that we'd see a jump over 450 on the 10-year before the war, but we're not, right? And it looks like Warsh will get through if President Trump can get Jeanine Pirro to back off. So what do you think about rates? Yeah,
so what a great, someone said to me yesterday, said, what would it take? If we couldn't get rates up on what we've seen in the last month, what's it going to take? And so, Matt, what you're really asking me is what's the multiple? We've already discussed earnings. Rates determine the multiple. And if rates aren't going up, then I look and say, well, 375, maybe it's 380 by the end of the year. Does that justify a 20 multiple? Given where rates are, I think it does. And so, again, I go back to if we didn't see rates go up on what we've seen the last month.
So basically, you're worried about the frothiness of this market. You're worried about retail over-exuberance. But doesn't that just cause maybe a short-term dip
100%.
That gives you an opportunity to get back in?
To me, it says something's about to happen out there that we don't know about. People say, well, what's the unknown? Well, if we knew the unknown, it wouldn't be the unknown. But the market is not set up to withstand that, given a little bit of the froth that's come back into the market.
What do you do in the meantime before that froth comes out?
You make sure your companies are delivering on earnings. I think you go back to the earnings, or what companies are really delivering, and which are not, and you stick with them and gut it out. But, ultimately, chasing after unprofitable tech is not a very good trade.
So active management is key.
Not the index.
Well, but the index is, I'm an active manager, but the index is full of a lot of very large cap tech stocks that are doing very well fundamentally.
You'd be doing really well right now if you were owning the index.
But they've been left behind the last, kind of week and a half.
Andrew, great having you here with us on set. Thank you so much for coming in to 731 Lex. Andrew Slimmon there of Morgan Stanley. Let's get a look at what's going on in the markets right now. We continue to see small drops in the S&P 500 after closing at a record high yesterday. Right now down about 14 points to 71.25. The NASDAQ off a little bit more, but still at 26,858. It's sitting right at an all-time high. The Dow not back up over 50,000, but it also doesn't look weak at 49,387, and Brent holding at above $100 a barrel.
It's fourth consecutive day of gains for Brent Crude, and stocks continue to trade around all-time highs. Some of the single-name stocks we're watching, Tesla had earnings. They did raise their AI and robotic spending plan to $25 billion. That's triple last year's CapEx, and shares fall.
American Airlines lowering its full-year earnings target, citing $4 billion in additional fuel costs from the war in Iran, and yet the stock is up 3.5%.
And maybe one of the best stock stories in recent days, that explosive rally in Avis shares has hit a wall. The stock has plunged over 57% in just 2 days. We've already had, I think, 2 trading halts this morning because of the volatility. By the way, I kind of love the sell side's reaction to this. So Morgan Stanley downgrades, saying that its unsustainable valuation is not supported by fundamentals. Of course, that's the whole point.
Yeah.
That's why the hedge fund jumped in. They wanted to drive up prices because of the short squeeze. They didn't think that it was
stock was trading at $850 yesterday,
so
and today it's down to $295. We have some breaking news as well. It looks like Warner Brothers investors have approved its $110 billion sale to Paramount. I guess this was just a formality, but it's still important. And exactly, as a result, the shares do a whole lot of nothing. At Warner, Paramount shares are down 4%.
Coming up on the show, American Express beats estimates. Premium card spending stays strong. That's coming up next, right here on Bloomberg Open Interest.
Let's get now to high interest. Look at what's making headlines around the world. Oil trader Pierre Andron's flagship fund cratered 52% early this month, erasing gains from a blockbuster March rally tied to the Iran war. The fund is now down about 37% this year, underscoring extreme volatility as oil swings on shifting geopolitics. JP Morgan is re-entering private credit, aiming to deploy tens of billions of dollars into loans sourced by its own bankers. The bank is raising initial capital from institutional investors, rebuilding ground lost after spinning off HPS in 2016. Despite warning of credit risks, CEO Jamie Dimon sees opportunity, or maybe because of those warnings, CEO Jamie Dimon sees opportunity as rivals face stress. And American Express is topping expectations as its premium customers keep spending despite higher energy prices. The CEO, Steve Squeri, spoke with Bloomberg The Close host Romaine Bostick about the resilient consumer, saying, quote, "It's hard to square my concern with record travel bookings and record billings. We're not seeing any lending indicators from a credit perspective or from a bookings or spending perspective." Dani?
Joining us now is the man behind that interview. It's Romaine Bostick, co-host of The Close. Romaine, it seems like a robust quarter, even though shares are down. So what was behind that?
Well, there's a couple of issues. I mean, spending is phenomenal. You're talking about 11% on the retail side. For luxury spending, it's like 18%. Premium travel's up like 12%. But their costs have been going up as well. Remember, they have launched a couple of new cards, which of course comes with huge advertising and marketing expenses. That's what kind of dinged them in the previous quarter for the Q4 reporting season. Now, I did speak with the CEO, and he said he's not too concerned about these marketing expenses and that they will sort of smooth out over time. But there are a lot of concerns here about the state of the economy. And I peppered him with a lot of questions about that. I basically asked him to point out, I was like, when do you become concerned? Yeah, it may not have impacted you. And he kind of quipped, well, I'll become concerned when people stop spending. And that really was kind of the tale of the last 3 months. The big question is, what are the next 3 months going to look like?
I always think about the Platinum card because it's been like a hot story.
Yeah.
They raised the price of it, but they also raised the amount.
Like $200, yeah.
But they raised the amount of perks that you can get back if you work very hard. And I've never worked harder in my entire life to get money back from credit card perks than I have. Exactly. I'm going to Lululemon every quarter for the $75 credit.
Well, they've really been masterful in the way that they've used these perks in order to sort of keep people to not only get new signups for the cards, but to keep people tethered to them. One thing that Steve Squeri talks a lot about is the retention rate, which I think is running at like 99% for like new customers. Basically, the idea is that once you get these cards, you don't give them up. And yeah, they've gotten more expensive. I think you're paying basically $8.95 a year, which is pretty high. I mean, you're rich, Matt, so I mean, I know that doesn't hurt you. But it gets to the idea of the type of customer they're really going for. They want a more affluent customer. They want a younger customer as well, the Gen Z. Sorry, Matt. But it gets to this idea of where they really think they can sort of maintain not only their revenue growth, but their profitability.
I want to be a younger customer.
I was going to say, I like that you didn't apologize to me because you think maybe I could be Gen Z. I really appreciate that, Romain.
Yeah.
On air travel, it does seem like a bit of a contradiction. And this is, Matt was pointing out your quote from the CEO, this idea that air travel has been slowing, but we've been hearing from the airlines, they're raising prices, they're keeping them there, people are still spending. So what accounts for the difference?
Well, I just got off the conference call, and it was interesting because the CFO was asked about this by an analyst, and the CFO, I thought, said something interesting. He said that they had actually seen a certain degree of refunds with regards to air travel over the last few weeks, which seems to suggest this didn't necessarily show up in the 3 months ended in March, but definitely something to keep an eye on looking forward, though he did also say that he doesn't think it's going to have a material impact. But when I was speaking with Squeri earlier before the call, I said, look, are you worried about any potential slowdown in travel? He said, look, he's like, yeah, we're seeing slowdown in travel in the Middle East. Nobody's going to Doha, but they are going to other places as well. So he thinks it'll balance out.
All right. Well, I look forward to watching you on the close this evening. You guys do a masterful job.
Every day, Matt.
I know. Yes. I listen every day. Sure. I actually listen. So what I hear is the simulcast. Yes. And you guys do a masterful job of breaking earnings there. Catch Romain and Katie on the close starting at 3 p.m. and going through the bell to 5. Still ahead, Blackstone seeing a strong start to the year for deal making. We'll bring you more of our interview with the company's president, John Gray, next. This is Bloomberg Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Quick check of what's going on with stocks today after hitting an all-new record high at the close yesterday. We're off only about 0.1% on the S&P, still at 71.29. The Nasdaq 100 down 0.3 at 26,858. Take a look at what's going on with the dollar right now. Well, it's unchanged. Brent crude gains are less than what we've seen. We're off the highs of the session at 102.58. This is fascinating. And okay, today the SOX index is up almost 2%. But if you look at a longer term chart, it's just up and to the right. 17 days of gains in a row. We haven't been down on the SOX since last month. It's the longest winning streak since 1994. And the index has had its best month since 2020. So Semiconductors doing very well. With that said, NVIDIA, the biggest one in the world, is down 0.2%. TSMC, the biggest actual chip maker in the world, is down 0.7%. But AMD is up, Intel is gaining, and TI is up 16% right now, Dani. So
it's everything in the stocks. I mean, TI had really good earnings, so that adds to it. Intel's getting that investment from Tesla, but it's hard not to look at that price chart and get this kind of bubbly feeling coming from it, just because there hasn't really been a huge driver. Sure, earnings now. And then at the same time, Andrew Slimmon was pointing out to us that unprofitable tech, that's also just been up and to the right. It's a feeling, again, when you're buying that sort of thing, not driven by fundamentals, but rather exuberance.
Yeah, a little bit bubblicious. And it, frankly, has to be to keep this kind of CapEx party going, right? I mean, Tesla's spending $25 billion, but other companies are spending $100 or $200 billion in annual CapEx, and you need that to build out these data centers, to power these data centers, and obviously the demand is there, so you've got to be able to fund the supply.
That is exactly my thought, that we kind of need a bubble to be happening. Because if these things aren't commanding the valuations they are, if you're not willing to buy into an Anthropic or an OpenAI at $800 billion, that means their cost of capital gets all that more expensive. You need a low cost of capital. You need a Blackstone raising, an insane amount of money and plowing that into infrastructure AI in order for this project to be realized, in order for AI to achieve what the promise of it is.
All just a reminder that Sam Bankman-Fried was a brilliant investor. Is a brilliant investor. He's not gone yet. Coming up, airlines face turbulence as fuel costs surge and outlooks come under pressure. That's next. This is Bloomberg Open Interest. American Airlines warning of a potential loss, citing a $4 billion fuel hit from the Iran conflict. And yet, the shares are surging in today's trade. Bloomberg's Benedict Campbell, managing editor for Space and Aviation, joins us now out of Berlin with an Ed Meyer tie that I absolutely love. Benny, let me ask first about the gain in the shares here. It seems to me that investors are grasping onto the idea that this is going to allow the carriers to raise prices, maybe substantially, and keep those price increases even after or if jet fuel prices come back down to closer to pre-war levels.
That's exactly what's going on. We heard something similar from Scott Kirby yesterday at United, and we heard it again today from Bob Isom at American, that they are benefiting from the continued strong demand that is out there, particularly on the premium side, in the business class and premium economy, and people are absorbing and are willing to absorb these higher costs, the higher ticket prices, and they can pass these through. United said yesterday that they thought by the end of the year, they'll be able to have passed through 100% of the additional cost. Bob Isom a little bit more pessimistic, more towards 90%, but still, the vast majority of these additional costs, and in Americans' case, we're talking $4 billion in additional fuel costs, they will be able to pass these on. And I think that's where some of this optimism comes from. This is a healthy and robust market. It still is, and they're coming into this with these higher costs, but they're able to pass them on.
There's also some interesting moves happening in the background between M&A, government deals. On one hand, you have the Portuguese trying to offload their stake in TAP. And then on the other side of things, our reporting suggests that Spirit Airlines might get as much as a 90% investment in the U.S. government. Benny, how much of it has to do with the stress of higher fuel prices? Obviously, Spirit has had issues before that, but does this kind of compound some of the movements we're seeing from governments?
In Spirit's case, certainly what's happened in the market now has compounded their issues. But as you said, this is an airline that was in trouble previously. If you talk to other executives, they'll gladly tell you they think that business model is broken, the ultra-low-cost model, and this is a zombie airline that possibly shouldn't be saved, but now it'll be the taxpayer holding the can. That's at least the way it's going at the moment. On the TAP side in Portugal, it's a little different. This is an airline that has been up for sale for a while. And the three big European carriers have been sniffing around that particular asset. The unique thing is the travel to Latin America. That's what makes them attractive. Lufthansa and Air France are the remaining two bidders. IAG, they own Iberia and they own British Airways. They've pulled out because they probably thought we don't really have a fair chance in this, given we already own a big part of that operation to Latin America. But Lufthansa and Air France, they'll now be slugging it out. So one airline sort of going away from the government, and the other one is, in Spirit's case, going towards the government.
Hey, Benny, thank you very much for joining us. That's Bloomberg's Benedict Campbell on the airlines. Let's get you a check on your markets about an hour into your trading day. And we're basically unchanged now on the S&P, still hovering around all-time highs. The NASDAQ also hit another all-time high. And then semiconductors on track for their 17th straight day of gains. That's the most ever since this index was created in 1994. It's having its best run over the past month since 2000. All of that going on despite the fact Brent crude is still above $100 a barrel. That would be its fourth day above $100 a barrel.
All right. I guess the idea, though, is that it just looks better than it has previously been, closer to 120 a barrel. Let's get a look at some of the single stocks on the move at this hour. International Business Machines reporting software sales in line with estimates, failing to shake investor concerns, though, about an AI disruption to its business. And as a result, the company, Big Blue, is literally decimated in today's trade. That means reduced by a tenth.
Okay, you can use decimated when it's reduced by a tenth.
Decimated means reduced by a tenth, although many people think it means reduced to a tenth, but that's not the case.
Right, got it. Yeah. Okay, yeah, fair enough. Anyway, Hasbro reporting prelim earnings, revenue rather, that beat estimates, boosted by its fantasy card game, Magic the Gathering, shares up 8.5%.
I've been to the Magic the Gathering headquarters in Seattle. It's actually
sweet?
Very cool, yeah, I have to say. Lululemon tapped Nike veteran Heidi O'Neill as its next CEO as Lulu struggles to dominate the athleisure category that it actually helped to create. And as a result, the shares, I think this is the biggest drop Lulu's seen since like March of 2020.
Yeah, it's pretty painful. Down, more than decimated, as a matter of fact.
Indeed.
Down 11%.
Indeed.
Its biggest drop at the moment since September of 2025, but at one point it was down 12%. Coming up, another earnings story. Blackstone's president says that the economy is healthy despite headwinds from the war in the Middle East. A very optimistic John Gray talking about still the year of the IPO despite software write-downs. More of that conversation coming up next, right here. Blackstone, the world's largest alternative asset manager, expects 2026 to be its best year ever for IPOs. I spoke with the company's president and COO, John Gray, on a wide range of topics, including concerns around private credit.
When you have this much noise in the system and concern, it will result in investors potentially looking for liquidity. So it's not unreasonable to expect this will take some time to work through. The key will be, do the products continue to show resiliency? And what's nice is, because the yields are high, in the case of our BDC BCRED, more than a 9% yield, you can absorb losses, and you have a very lowly leveraged structure. So if you think about a bank that's typically, call it 12 times levered, these vehicles for us less than 1 times levered. So if these vehicles can deliver a premium in performance, as they have to liquid leverage loans, investors will say, wow, these things are more resilient than I expected. They continue to deliver positive results, and then this will ebb over time, but it may take a bit to work through.
What's a bit? Is that like quarters, years? What does it look like?
It's hard to say. I would think it would be more quarters than years, but you'll have to see how the environment evolves. And obviously, as base rates come down, that, of course, is a headwind as well from an absolute return standpoint, but not from a relative return standpoint.
Even with the fears in private credit, it has been capital markets and M&A and activity that has been extremely robust. And John, I think that would surprise a lot of people coming into this year, considering we've had the fears over AI, disruption still on trade, and now a war on our hands. What are you seeing in your portfolio companies? Are there any stresses around energy costs and inflation?
What we've seen is remarkably strong. I mean, in Q1, our private equity portfolio had 10% revenue growth, which was an acceleration from Q4. And so, yes, there are isolated companies, particularly in Europe, who are facing higher energy costs. There, natural gas has gone up quite a bit, which is very different than the United States. Some companies are still dealing with some tariff issues. There's slowness or more challenges, I would say, in mid and lower end consumer businesses. But in aggregate, the picture is pretty good. And the big driver goes back to what we talked about at the beginning, this huge AI infrastructure boom. 5 companies spending $700 billion in capital. Just us alone, we think this year our data center business that we could lease across all our platforms 6 gigawatts. 6 gigawatts, to put in context, is almost $100 billion of data centers. There'll be another couple $100 billion of chips put in by the hyperscalers. That's 300 billion of aggregate spend. That's like the economy of Portugal or Finland. And so I think that tailwind to the overall economy globally, but particularly in the United States, is powerful, which is one of the reasons why even as we have a shock like we're seeing with the war, we can continue to power through. Our expectation is we'll see a pretty healthy economy despite these headwinds.
Those numbers boggle my puny little human brain, so thank you for laying them out. But as we see higher energy prices, still the Strait of Hormuz is closed, gasoline prices go up. It's a market, and I know you're in private markets for a reason, but public markets are trading at all-time highs. Do you think there's an element at which we are maybe a little bit too sanguine about wider risks and disruption from what's happening in the Middle East?
Well, I think the market has begun to develop a perspective because this is now the 5th time since 2020 where in the first quarter of the year we've had a shock, right? COVID, which was obviously very big. We had the Russia invasion of Ukraine, which created an energy crisis. We had Silicon Valley Bank, which shook the financial markets. We had Liberation Day, which hit companies and markets, and now this. And in each one of those previous experiences, the market traded off, people were highly concerned, and ultimately the returns, the market recovered by the end of the year. And so I think the market has now been conditioned a little bit to say, hey, we should have a bit of patience, that there will at some point here be a resolution, and we'll go back to underlying fundamentals, which again is a pretty healthy global economy and inflation away from energy prices generally heading lower in terms of certainly rental housing costs, labor market cooling, and then these big productivity gains, which should be beneficial for earnings growth and economic growth. So I'm not sure the market has it wrong. If the conflict escalates, things could obviously change. But based on past history and the underlying strength of the U.S. economy in particular, I think it's reasonable for the market to stay optimistic.
Related to this, John, is the year of the IPO. I know you said it to start the year. There were some question marks because of everything we're discussing. But given the resiliency, the fact that liftoff, yes, gets delayed, but it's back on the docket. Jersey Mike's also going to be coming public, too. At this point, can anything stop the year of the IPO, or is this a train that's just going to keep running?
Well, I would say I still think, as you noted, this is the year of the IPO. That prediction was not looking so good 30 days ago. But I think because of the strength in AI, in 3 of the biggest tech companies in the world are likely over the next 12, 18 months to go public. We're fortunately in our wealth vehicle investors in all 3. We have a number of companies, I can't comment on specifics, that are on the docket that we think the market will receive well. But what I'd say is there's really a bifurcation. There are companies that are in sort of the path of AI, direct beneficiaries. The market wants more exposure to those companies. There are companies that are sort of AI unaffected, like our Medline business, which we took public at the end of last year in medical supplies. There's a lot of enthusiasm for that. The one area where I would say it's much tougher is in those white-collar sort of job services areas. That's professional services, information services, software. There, because the market has concerns about what the business model will look like over time, that's going to be tougher. But the rest of that market's big enough that I think it can support a fair number of IPOs. We right now have 9 of them filed globally in the US, Europe, and Asia. And so we do think this should be our busiest year ever for IPOs at Blackstone.
My interview with Blackstone President and COO John Gray. And I got to say, I mean, he was measured in both the IPO response and in just the idea of how they're navigating all of the software stuff. He was like, look, there is still more pain to come out there. We talked about Thoma Bravo's Medallia. He mentioned that they lost more than $5 billion on the deal, too. So he said, yeah, things look good, but not for everybody.
But Thoma Bravo lost more than $5 billion.
Yes, yeah, correct.
Deal.
Not, to be very clear, not.
Yeah, because they bought
Blackstone.
Medallia for like 6.5, and now it looks like they're ready to pass the keys. I think the AI stuff also is fascinating with regards to software. ServiceNow is down like 17% in today's session, even though revenue rose 22% in the first quarter. So we will talk with Bill McDermott, the CEO of ServiceNow, next, or rather Caroline Hyde from Bloomberg Tech will come on and interview Bill McDermott and find out what he has to say about this nearly 20% drop in his stock, the biggest in 6 years. Next, this is Bloomberg Open Interest. Software stocks are falling, and as I said before the break, ServiceNow itself down 17%, the biggest drop in 6 years, even though subscription revenue rose 22% in the March quarter. Bloomberg Tech's co-host Caroline Hyde joins us now with the CEO of ServiceNow, Bill McDermott. Caroline?
Matt, that is great context with which to turn to Bill. Even though subscription growth is still 22%, you beat on revenue. What more can you tell a market right now, Bill?
I think it's very important to deal with facts. We're a $15 billion enterprise software company, the fastest to ever get there, growing at more than 20%. We had a beat and raise quarter, and we reiterated our full year guidance. So that's the baseline for the conversation. And we are a growth company, and I'll take the interview any way you want it to go.
Let's talk about geopolitical headwinds. Let's talk about acquisition integration expenses. Maybe there's some of the areas that investors and the analysts have said, look, it made for a bit more of a messy quarter than perhaps would have been easier for you to tell the story on. What is the underlying growth rate of AI at the moment, of adoption of the ServiceNow products?
Yeah, what you have to realize is AI is the product. It's the whole platform. So the platform is fully autonomous. So when a customer buys our AI platform, it is enabling every function of their company to be a native AI company. So it's all AI now. And that's another thing. We said we would do in 2026, $1 billion of net new annual contract value on pure AI additive to the platform. Yesterday, we upped it to $1.5 billion, and I think we'll run through that. So if there's anything that the investors wanted, they probably wanted a bigger beat. So we're beating every quarter. Maybe they wanted a bigger beat. And then the second thing is, and it is true, we acquired a couple of companies. So let's talk about that. One was MoveWorks, where in 1 quarter, we only had in 1 quarter, we did in 1 quarter what they never did in a whole year before they became part of ServiceNow. So the go-to-market machine knows how to take great innovation and monetize it. Secondly, we took Veza and Armis. Veza just joined us. Armis just joined us on Monday. So the market might have said, are they doing M&A to cover up for any lack of growth in the core? How could that be true when it wasn't even in the number? And so these companies are fantastic because now you're going to manage the identity of humans and agents, which is really important when you're the rails and rules of every major corporation in the world. You want AI that works with humans and does so in a highly controlled manner. That's Veza. And then Armis is operating technology, where now you're managing all of the IoT of everything, networks, devices, and so forth, to keep these companies highly secure. Yeah. As you know better than anybody, Caroline, cybercrime is the 3rd largest economy in the world. It's $1 trillion a month problem. And now we've opened up our TAM to 600 billion TAM. So we're going after the biggest ocean of opportunity we've ever looked at. We're growing strong, and we're very confident in our full year guide. So I think the market is the best entry point that I could ever imagine for this stock.
You've actually bought stock. And actually, a lot of those in the C-suite are stopping automatically selling it. How much more do you think you have to buy to really push off this bear case that's got into the investor mindset?
I think the bear case is really just the terminal value of software as a service companies. It has nothing to do with just ServiceNow. It's like anything that represents, maybe it wasn't as big a guide beat as we are used to and so forth. Is just a real reality of, where do the language models, and these are excellent companies. The hyperscalers are great companies. The language models are excellent companies. We did a deal yesterday with Gemini. We've done a deal with OpenAI and Anthropic. We infuse them into our innovation cycle, and they integrate with us to make sure that AI is done properly in enterprise. And the 95 billion workflows and 7 trillion transactions we have reside over data that it took us 22 years to build. So it's that context engine that we have that brings those language models to life. And they know that. But the market might think, hey, maybe I can do everything with a language model and build it myself, which is not going to happen. Every CIO and CEO will tell you, ServiceNow, for a fraction of my overall IT spend, does enormous work for me. Why would I rebuild it with a language model and pay 10 times more? So that's not even a viable comparison. But yet, comparisons like that exist until proven different.
What will prove it different, Bill? You're such an optimistic guy, and I can sort of sense it today, that energy is being hit by the fact that the stock is having the worst pummeling on record. And you've got RBC saying software sentiment is some of the lowest level in memory. What changes, what shifts sentiment, do you think?
Leadership. You know, the most powerful thing a leader can do is change minds. And the best thing that can change people's minds is performance. And that's why I reiterated with great confidence our full year guidance. I'll be in front of 30,000 people in a few minutes, firing them up on the game plan that we have well in order. The M&A that we did will be additive to a great corporation. This is the fastest growing enterprise software company of all time. First to get to 15 billion. It'll be the first to get to 32 billion. And we're excited to have our shareholders join us in Nevada, Las Vegas in a couple of weeks to explain the midterm and the long-term plan of ServiceNow, which is to double the company in the next few years. So we're excited. We're ready to go. And I would really underplay the narrative that's out there on enterprise software, not just ours, but these large-scale systems are not going to be replaced by language models. They'll be very complementary to the large-scale systems, but they're not going to replace them. So we have been at this now for quite a while in the enterprise. I know how the enterprise works. People just need to keep their chin up and get really serious about making money at a down moment like this. It's never been like this before, so take advantage of it.
We'll let you get to your talent meeting, get those chins up. Bill McDermott, we so appreciate your time at ServiceNow. Thank you.
Carolyn, hi, we thank you as well, and our thanks to Bill from ServiceNow. Bloomberg Tech is up next, so you'll get more from Caroline and from Ed. It is fascinating to see those huge drops, even with the continued rise in revenue. I mean, 22% increase in subscription revenue. You would have thought if people were replacing their subscriptions with AI that you would see a drop, and actually it's gone the other way. Coming out tomorrow, Mike Wilson of Morgan Stanley, Dana Doria of Envestnet, plus the CEOs of Baker Hughes and ChargePoint, plus Dani, it's Friday.
Oh, thank goodness.
Yeah, it's pretty cool,
Can't
right?
wait. It's pretty cool. TGIF tomorrow. Stay with us for that.